A few rays of sunshine in this past week's chaos. Cheaper oil and the dollar crash that did not happen. Hello, members, super savers, and bond course fans. I hope you're healthy and well, and welcome back to our weekly update. There's been so much doom and gloom in the news this week about tariffs and the markets that we thought it would be worth talking about a potential big win for our country's consumers that's been mostly overshadowed in the media by everything else that's been going on. And that potential big win is a sharp drop in oil prices last week that will impact nearly all our wallets. So, with that in mind, here are the 3 topics that we'll be covering in today's video. 1. Did President Trump score an oil price cut from OPEC and its allies, and no one noticed? In this section, we'll also address some of the comments and emails that some of you sent our way about tariffs crashing the dollar. 2. Which treasuries rose the most and which ones fell this past week? And 3. What are the expected yields for the upcoming week's treasury auctions? Plus, what are the highest yielding opportunities for new issue agencies, corporates, and brokered CDs right now? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. Did President Trump score an oil price cut from OPEC and its allies, and no one noticed? Well, strictly speaking, a few media outlets such as Bloomberg and Business Insider did notice, as you can see from this article, oil prices are crashing after tariffs and OPEC deliver a double whammy to energy markets. So this oil price crash, or to put it more positively for those of us who are net consumers of oil, this sharp drop in oil prices after President Trump's tariff announcement, while it may have been a big win for the current administration, it was also much less prominently reported in the media than the carnage in the broader market. The price of oil as measured by the WTI, the West Texas Intermediate Future, was down 6.92% on Friday alone, when it fell from $66.95 to $62.32 per barrel. And for the week, oil was down even more, falling by 10.5%. This is the lowest price that oil has hit over at least the last 3 years, as you can see here. Oil prices had already started trending lower on Thursday on concerns of lower demand due to tariff, trade, and recession uncertainty. But it was what happened next that really pushed oil prices down further, something that no one would have predicted, as Bloomberg reports. Hours later, the Organization of the Petroleum Exporting Countries, OPEC, and its allies unexpectedly said that they would add more than 400,000 barrels of daily output back to the market next month. That was 3 times the amount the group had previously planned to revive, signaling a significant policy shift after years of supply constraints that had supported crude prices. So, rather than cutting back on supply, which is what you would normally do if you expect less demand, OPEC is actually increasing the supply of oil in the marketplace. The official explanation that OPEC put in its press release on Thursday was that the surprise production increase was intended to put pressure on quota cheats. Quota cheats are countries that produce and sell more oil than they're supposed to, so that they can profit from higher oil revenues. And OPEC's story is that by producing more oil, they will be able to drive down oil prices for everyone until the quota-cheating countries are hurting so much that they fall back in line and restrict their production again. But there's another theory out there as well. As Bloomberg explains, OPEC Plus has also faced external pressure from Trump to cut the price of crude. This may not be a completely implausible theory. Since his campaign, President Trump has made cheaper energy a pillar of his platform, and lower oil prices would help him not only by reducing inflation for American consumers, they could also help cushion the fallout from his new tariffs and put pressure on rogue countries like Iran and Venezuela. And if you follow that line of thinking, rather than assume that OPEC really wanted to punish Kazakhstan so badly for cheating on its quotas that it had to be done just a few hours after Trump's tariff announcements, then Bloomberg summarizes the week in oil markets quite well. The 2 moves sent shockwaves across oil markets. though potentially offer a win for Trump, who has repeatedly bemoaned high crude prices. What do you think? Was this a coincidence and President Trump just got lucky with this oil price win? Or was there a reason that prominent figures from the United States, Saudi Arabia, and other oil-producing countries have been paying one another regular visits recently? Drop a comment below and let us know your thoughts on this. So, that was oil prices. But cheaper as oil may have become, we still have to pay for every barrel. So, let's talk a bit about what we use to pay for that oil, our US dollar. Here are a few prominent headlines about the dollar falling sharply this past week, some of which a few of you have actually sent our way. And I can see why some of you were freaked out from these dollar falling and dollar dropping articles. And once more, I may have some good news for you here. Unlike the oil price drop, which happened but did not make most headlines, the dollar fall that made the headlines didn't really last to the end of the week. Yes, the dollar index was down a bit on Thursday as the market initially digested the tariff news, but then it recovered most of its initial losses and ended the week almost where it started at 102.89 points, down a relatively modest 1.1% versus the 104 points from the end of last week. And let's have a look at the big picture as well. This chart shows us that the dollar has come down a bit from the high it had reached at the beginning of this year. It's down by 6.2% to be precise, but it is currently still comfortably within the overall range of the past 3 years, I would say. So overall, what we lived through last week were a few bad or even very bad days for the broader market after the tariff announcement, but much less bad or even outright better news for oil prices and the dollar than you might have suspected from just following many of the headlines and breaking news out there. Hopefully, this somewhat positive news on oil and the dollar in an overall difficult week will help some of you sleep better at least for a day or two. Because who knows what'll happen next, right? We're living in such fluid and uncertain times. Tomorrow may look quite different from where we are now. So much so that it's even more difficult than usual to predict the future. In any case, let's keep going and move on to the next section of today's video, bond yields, which also had a very eventful week. Which treasuries rose the most and which ones fell this past week? As we so often do at the end of the week, let's grab our rates from the Treasury's daily Treasury par yield curve rates page and compare Treasury yields from this past Friday versus the previous week. Here we have all the maturities that the Treasury issues at auction. Here's where yields stood this past Friday, and here's where yields stood at the end of the previous week. And here's the increase or decrease in rates over the past week. Increases in rates are shown in black, and decreases in rates are shown in red. The 2-month was up, but only slightly by 1 basis points. The 1.5-month or 6-week was unchanged. Treasury yields across all other maturities were down significantly, though, driven by what we've been talking about the past several days on this channel, President Trump's tariff announcements and concerns around inflation, interest rates, and a possible recession. Down the most were the 3-year at minus 25 basis points, the 5-year at minus 26 basis points, the 7-year at minus 27 basis points, and the 10-year at minus 26 basis points. To say it once more, it was an ugly week for markets. All maturities between 1 year and 7 year are now below 4%. The 10-year also dipped below 4% briefly on Friday, but managed to edge itself back up just before close of market to 4.01%. Let's see if it can hold on to its 4 handle this coming week, or whether renewed market turmoil will push it below 4 again. Now, let's take a look at Treasury yields from this past Friday versus the beginning of the year. This row shows where rates ended this past Friday. This row shows where rates were on January 2nd of this year. And this row shows the increase or decrease in rates in 2025 so far. Decreases in rates are shown in red. Up until this past week, the 6-month T-bill had been the only maturity that was slightly up since the beginning of the year, although last week it was clinging on by only a tiny 1 basis point increase. Too bad that didn't last. Treasuries across all maturities are now lower than where they were on January 2nd, with the single exception of the 2-month, which is unchanged. Down the most are the 3-year at minus 63 basis points, the 5-year at minus 66 basis points, and the 7-year at minus 63 basis points. The yield curve has gotten a lot flatter, with the 1-month and 30-year showing a positive difference of only 5 basis points versus 26 basis points last week. And the more widely used comparison of the 2-year and the 10-year is showing a narrower positive difference of 33 basis points versus 38 basis points last week. Meaning that everyone's a bit more pessimistic all around in the bond market, which again is to be expected given the week's downward moves across nearly every market index. Let's see whether we're heading into a better week or whether the yield curve will continue to flatten or, in the worst case, possibly even invert again and point towards a potential recession. It wouldn't come out of the blue if that were to happen, but who knows? You can find more details on these rates for any day of the week that the bond market is open on the Treasury's daily Treasury par yield curve rates page, as I mentioned earlier. All sources are linked below in the first pinned comment. Do keep in mind that this overview gives you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ a little bit from what's shown here. Now that we've covered Treasury yields from this past week, let's move on to the next section of today's video. What are the expected yields for the upcoming week's Treasury auctions? Plus, what are the highest yielding opportunities for new issue agencies, corporates, and brokered CDs right now? Here we are at Treasury Direct's upcoming auctions page. If we scroll down, we can see that all the weekly T-bill auctions are happening as usual. There's also a 14-day CMB on the auction schedule. This is the second or third time we've seen a 14-day CMB on the auction schedule recently, so it'll be an interesting one to watch. Maybe we'll be seeing 14-day CMBs more and more often in the coming weeks. The 3-year T-note, the 10-year T-note, and the 30-year T-bond will be auctioned off as well this upcoming week. The 10-year T-note and the 30-year T-bond are reopening auctions, so we already know the coupon on those. At the time of this taping on Fidelity's platform, here's what the coupon and the expected yield are for the 3-year T-note auction. And here's what the coupon and the expected yield are for the 10-year T-note auction. And here's what the coupon and the expected yield are for the 30-year T-bond auction. Do keep in mind that all of these numbers can and usually do change all the way up to the time of the auction. So that was Treasuries. For those of you who may be interested in other types of bonds and CDs, the highest yielding new issue agency bond on Fidelity's platform at the time of this taping is from Federal Home Loan Banks at 5.72% with a first call date in July 2025. The QSIP is 3130B5ST6 for those of you who may be interested. For corporate bonds, the highest yielding new issue is again from Jefferies Financial Group at 6.5% with a first call date in April 2028. The QSIP is 47233WJL4 for those of you who may be interested. For brokered CDs, the highest yielding one is from Beal Bank at 4.2%. It's call protected with a maturity date of June 2025. As always, if you know of any bank CDs or checking and savings accounts with particularly attractive rates at the moment, then please do drop them below and let me and the community know. All right, members, super savers, and bond course fans, I hope you enjoyed this video and learned something new. And as always, if you want to learn more about bond investing and building a bond portfolio, then check out this video here on our bond courses. And come join our next live member Q&A on Saturday, April 19th at 5 p.m. Eastern Time, 2 p.m. Pacific Time. We'll be diving deeper into the 2, 5, and 7-year T-note auctions and all things fixed income. I've also linked all the details on our bond courses and YouTube Super Saver membership below this video for your convenience. Good luck to everyone who's planning on picking up some bonds and or CDs this coming week. And see you again very soon with more brand new wealth building content for your financial journey.